to this. Let's start with market structure. So we have two types of market structure. We have the basic market structure, which I believe you are very, very aware of. When we have higher lows, higher highs, higher lows, higher highs, higher lows, higher highs. This is an uptrend, and where we have our lower low, lower high, lower low, lower high, which is our downtrend. And also we have consolidating or ranging markets. These are just normal basic market structure, which I believe that you know yourself personally. So please, I want this session to be like our session to be communicative, in case maybe you have any stuff that you don't understand or stuff. So that's why I will meet you, so you can be communicating with each other. Are you with me?
Yes, I am.
All right. So we have the uptrend, we have the downtrend, and we have the ranging market. This is just normal basic market. This is what gives us insight that, okay, we are bearish in the market, we are bullish in the market is ranging or consolidating. So that is not our main focus for today. It's just like it's one of the type of the two market structures that we have, and it is necessary for a trader to know how this works. And leaving this now, we have the second one, which is our main focus. We call it the advanced market structure, and also we call it the algo structure. That's the way we have the SBI. That's our advanced market structure. So what does okay, let me start by saying the rules of the advanced market structure. Let me start with that. The advanced market structure has its own rules on its own. So the number one rule of the advanced market structure says that there must be a sweep of liquidity. There must be of liquidity. That's the number one rule of the advanced market structure. That is, if we have something like this, there must be, let's say we are in an uptrend now, for example, there must be a sweep of liquidity. Something like this happening. This is our number one rule, a sweep of liquidity. It is very, very essential and very, very important. Without this, we cannot take any trade. It is very, very important that there is a sweep of liquidity. That's our number one rule. And number two rule of the advanced market structure states that there must be a break of structure. So the opposite direction. This is the number two rule of the advanced market structure. There must be a break of structure to the opposite direction. So now, what did I mean? After this sweep has happened, now we are anticipating that price will do what? Price will break structure to the opposite direction. That's where our number two rule comes into play. So this is the number two rule of the advanced market structure. And all these rules are very, very important. Without these rules, it is not advisable to take trade. Number three is that there must be a retracement. So let me say between or above. Above or on 0.5 pip to. Very, very important. There must be a retracement to above or on 0.5 fib to. That is very, very important. So what did I mean here? After we have our sweep, which is the number 1 rule, we have our break of structure to the upside, which is the number 2 rule. Then we must have a retracement. Price must retrace to do something like this. Now, this is a retracement, right? That's our number 3 rule. Let me mark it like that. Our number 3rd rule, which is very, very important, is for price to retrace and give us these retracements. And using that, the rule says that there must be a retracement to above or on, let's say, to 0.5 Fibonacci 2. That is, you will now take your Fibonacci 2 from this low. You know, the sweep happened here. So from this low to this high, where the break of structure happened, to this high, where the price started retracing from. So you will take it from here, and you will be like here, from here to this high, not the break of structure now, but to the high where the price started retracing from. So the price must retrace to above or at 0.5. As you can see here now, you see that this is 0.5 Fibonacci 2. This is our 0.5 point, and price is
below. I think
below it.
sorry, you meant to write below, but you wrote above.
Oh, sorry. This is. Let me just write on or
below.
Okay. This is a bullish trend. Don't let me use on. Let me just write it as price must retrace to 0.5, so it won't convince you, because in a downtrend, for example, it will be below. In an uptrend, I mean, it will be above. In an uptrend, it will be below. So it is just, there must be a retracement to 0.5 Fibonacci 2. So you just get to understand what I'm saying, that if, let's say, the price did something like this, it is valid, still valid. But if something like this happen, you see that it's not inside this 0.5 at all. Something like this now is not valid. That means this rule is not intact. So if something like this happens and you see a sweep, you see a break of structure, do not take a trade like this. Why? Because the rule guiding the advanced market structure states that there must be a retracement to 0.52, which does not happen here. So you will not take this unless you have something like this. Then you can say, okay, you want to take it. So you have to make sure that you're using your Fibonacci tool to make sure that you confirm if price retrace or not. So moving away from that, we have the number 4 rule of the advanced market structure. The number 4 rule states that there must be a break of structure to the opposite direction. Let me write it as second break of structure. Second break of structure to the opposite direction. There must be a second break of structure. So what did I mean? From here now, where price retraced from, price will then do what? Break structure to the upside. Now we have our second break of structure from here. You can see that is our rule number 4, which is very, very important. Rule number 4 is very, very important. So right now, the first rule says that there must be a sweep of liquidity. This sweep has happened here. The second rule states that there must be a break of structure to the opposite direction. This is it. It is very, very important. The third rule states that there must be a retracement to 0.52. This retracement, you try to confirm, you check it from this low, the protected low, to where it started retracing from, the point where it started retracing from. And you make sure that the retracement is at or below or above 0.5 Fibonacci 2. Then the fourth rule states that there must be a second break of structure to the opposite direction. Now, all this here now is the advanced market structure. This is how the advanced market structure works. And the advanced market structure, as it states, you see this rule here is the rules of advanced market structure for type A. We have type A, we have type B. Are you with me?
Yes.
We have type A, we have type B. Let me just write this as type A. This is the type A of the advanced market structure, type A plus of the advanced market structure. These are the rows of the type A. It is on the type A that you have two break of structures. Compulsorily, it must happen. There must be two break of structures. The first break of structure, the second break of structure. And what are you anticipating? This is your protected low. This is your protected low. This is your liquidity. So what are you anticipating? You're anticipating price to come back into this zone. From here, price should come back into this zone and do what? Break another structure to the upside. So this is the main anticipation on this POI. That's what we are. We will be looking to like the first one, the type A. So now let's move to type B SBI pattern. Now on type B, the type B, so the number one rule of the type B, same as the first one, there must be a sweep of liquidity. That's the number one rule of the type B. So as you already know, this is a sweep of liquidity. This is our sweep of liquidity. So this is our number one rule. There must be a sweep of liquidity, which has happened here. This is our number one rule. So from here now, we move to the second rule. Now the second rule states that there must be a retracement at around 0.5 Fibonacci 2. This is the second rule. What did I mean here? There must be a break of structure, a retracement. This is what I mean here. A little retracement like this. This is the number two rule. There must be a retracement at around the 0.5 Fibonacci 2. This must happen before a break of structure. Are you with me?
Yes, yes.
This must happen before a break of structure. So the third rule, this one does not have a lot of rule. The third rule states that there must be break of structure, so the opposite direction. So that's the third rule. So what did I mean here? Price should break structure to the opposite direction this way. There must be a break of structure to the opposite direction. It is necessary and it is very, very compulsory. Very, very compulsory. Because without a break of structure, we cannot confirm that, okay, this market has given us something that we need to see before we can say, okay, this is what we are anticipating. So the Fibonacci 2, you take your Fibonacci 2 from this low, our protected low, to this point where the break of structure happened, from here to here. So the second rule, which is there must be a retracement, must happen inside this what's it called? It must be below or above 0.5. Depends. It depends. Let me see if I can invert the flow. So in a downtrend, you see, it will be above. So in an uptrend, it's going to be below. So it must be at 0.5. Either you like it or not, it must be. If something like this happen, you have something like this, it is not valid. It is not valid. It must be here. Even if it is just on top of it, like just a little bit at 0.5, it is still valid. But if it is not at 0.5 at all, it is not valid. That is the second rule. So in my own pattern of trading, I make use of my Fibonacci 2 a lot. So I will lure you also to learn how to make use of your Fibonacci to a lot as well. So what are we anticipating here? We're anticipating here our protected low. Here's our protected low, and here is our liquidity. Here's our liquidity. So here is our POI. Anything below the liquidity is our POI, because there are some time we have a valid order block, we have a breaker block, stuff like that here, and price will not come. Even there are some time we have a supply and demand on the lower time frame here, price will not come. If you, I don't know if you check the group, the V10s that I dropped, I think there are some multiple trades that I dropped that they just tap and go. They did not
Yeah.
really come into the POI that much. They just tap and they left, they continue moving. So it is not all trade that will come to the demand zone or the supply zone. Majority of them will just be like, the major reason why they are coming here is because of this liquidity that is here. They are only coming to take away this liquidity. And once they are able to achieve that target, they can start moving. That is the main reason why price is coming all the way from this high to come here. So it is now left to price to say, okay, I want to come and take out the demand zone or supply zone that is below here before I will say I want to buy. For here, it is a demand zone. If it is in from you're trying to sell, it is a supply zone. So price they can decide I want to come to the demand zone to buy, or I just want to do what? Just want to tap here and boom, I want to move on. So all that depends on what price wants to do. So market structure is not something that is very, very wide. It's just to let you know the template of what you are anticipating in the market. It's to let you know, okay, this is how the markets move. This is what you want to see. And also we have one other type of advanced market structure, but that one is really, I don't really think you need it, but I will still tell you, is type C. We call it the type C, plus. Okay, call it the type C plus. SBI model. It is not that complex. What just the first row as well is still the same thing. Without a sweep of liquidity, SBI is not valid. There must be a sweep of liquidity. Okay? There must be a sweep of liquidity. That is the number one rule in the type C as well. A sweep of liquidity is very, very important. That's our number one rule. So you want to see a sweep occur here. Without a sweep, if you're trading SBI, don't even look there, don't even think of any other thing. Once you don't see your sweep, just understand that market will always create opportunities. Market will always create opportunities. So if you're not seeing what you want to see, which is most importantly the sweep, just let the market do what? Just let the market be. So number two rule is that there must be a break of structure. There must be a break of structure to the opposite direction. That's the number two rule of type C plus entry model. So there must be a break of structure to the opposite direction. There must be a break of structure. It's to the opposite direction. It is very, very important. Very, very important. So this is the number two rule and the type C entry model. The reason why I'm saying that you might not need this type C because is that it is mainly used on higher time frames. It is not literally used on all these. I don't really use type C. Why? I don't use it because I feel like it does not give me what I want unless if I'm seeing it on, let's say, like 4 hours time frame, 8 hours time frame, daily time frame, or weekly time frame. That is when I can know and speed that, okay, I have a point of view, like a POI, a point of view that, okay, I'm looking up to. This is what I'm looking up to. So I expect markets to come here, then create what I now want to see on the lower time frame, let's say like 1 hour, 15 minutes for continuation. That is how I make use of my of this type C. So the third rule of type C is that price must retrace close to what's it called, the POI, because the concept behind type C is engineered liquidity. Are you with me?
Yes.
The concept behind type C is the engineered liquidity. This type B that you see here now, the concept behind type B is structural liquidity. The concept behind type A, it is the inducement liquidity. That's the liquidity concept behind each and every one of them. So this one, there must be a retracement to, let's say, if we're using our Fibonacci tool, that will be around, minimum of it must be around is 0.7, 0.78652, because it has to be very, very close, very, very close to the entry. There must be a retracement to around 0.7. That means if your entry is here, price must come very, very close to here. That is the third rule of the type C. That's the third rule of type C. There must be a retracement to around 0.768 Fibonacci 2. And what is the fourth rule? Now let me say this. In aspect of there are some confluences that I use if I want to take this trade. Let's say if price comes to retrace here, and let's say I have a key level around this zone here. You know about key level, price expecting it for continuation.
Oh,
So
yes.
that key level, I will anticipate that price must fail that key level before coming into my POI. That key level does not fail, there's high probability that this POI will not hold, because key level is meant for continuation. So number four rule of the type C, how am I going to put this? It's just like price has come to the 0.786. So price will retrace a bit before coming into POI. So if there is, like, let's say like there's a key level around that zone, price must take it out to let you confirm that yes, I want to buy. If you remember when we were under Sabi Girl's mentorship, she will tell you that when you have a POI that even have a valid demand or a valid order block in the POI in the disruption zone, like the disruption, if you have a key level closer to that disruption, it is likely that the POI fails. Why? Because price will want to respect that key level for continuation. So let me just say the fourth rule is you're anticipating that price should retrace for continuation. There must be a retracement for continuation. As I said, I'm not really a fan of type C. Even you yourself, if you start now, I'm very sure that you will have nothing to do with type C. It is just that if you're able to see type C on the higher time frame, you will know that okay, this is what market is trying to do. Let's say on the daily time frame, you see market did a sweep, a break of structure, then come do something like this, and you see the fourth rule which says a retracement for continuation, and you see something like this happen before price now come into this POI. This is the fourth rule, a retracement for continuation. So price will just do something like this, just retrace. Why? This retracement is not for anything. It's just for you to come into this POI, then continue. So in this POI now, we have our protected low here. Have our protected low. Now this one that comes here, this engineer liquidity, now becomes our liquidity in this zone. So where's our POI? Our POI is from anything below that engineer liquidity. As far as that engineer liquidity does not cover this sweep, it is very, very important that any trade you want to take, it is not that you're having something like this. There are some situations like this that happen. There will be a sweep and price will create a break of structure. You see this sweep here, it must not be in line with the liquidity. liquidity has to be around here. Like the sweep has to be very, very clear that yes, I had a sweep here, and the liquidity must not take cover up the sweep. Once the liquidity has covered up the sweep in something like this, the POI is no longer valid. Trust me, the POI
Okay.
is no longer valid. The sweep must happen accepted, but the liquidity must not cover the sweep. 1 minute, please.
Okay.
All right, sorry. So, as I hope you're able to get what I'm trying to explain here, right?
Yes.
All right. So that applies to all the three rules, all the three, I mean, the three types of the SBI pattern. It applies to the three, the type A, the type B, and the type C. So I will send you, I think maybe I should do a screenshot of this for you so you can, though I will still send you this recorded video so you can be able to watch it over time, able to know everything I said so far because we have like 3 minutes left for this class to end. So I'll send. Do you still need the screenshot or I
The
should
video is
just
okay.
the
No, the
video?
video is okay.
All right, no.
Yes.
So I'll send you the video so you can watch that at least for today. Watch this video, understand the advanced market structure. The template is very, very important. All these templates that I drew here, you must understand everything. So this one now, price will come for here. This one must not break structure.
Okay.
How do you understand me? It must not break structure before it comes back here.
Okay.
So that's the reason why I'm saying it is majorly used on higher time frame. It is not something that you use on the lower time frame. I think you have a bit of understanding about what we call engineered liquidity. When price does
Yes.
create any liquidity for the POI that we're anticipating price to respect, price will come to engineer it. A little retracement, then price will come back to take off this engineered liquidity for continuation. So that's just the little concept behind this. And this one as well, after price has given off a sweep, a break, and everything, our liquidity at 0.5, price will don't do what? Price will come back here and boom, it is going. So that's just everything that you need. So I'll send you the video. So after the class, I'll send you the video so you can watch it, repeat it, go into the charts, try to look at a trending market that is trending. Look at what the market is doing, check all these templates in them, 1 hour, 15 minutes, 4 hours, and so on. So just try to understand what the advanced market structure itself means. I hope that is clear.
Yes.
All right, so we're going to stop here. I think that's the end of
So
the class.